You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You know, part of what I said at the beginning, well, first of all, I'd love to invite anyone who's in the back to come on in and join us for this next panel, if you'd like to stay. One of the things that I mentioned at the beginning was that we have a long list of invaluable sponsors. One of those sponsors is Bank of America Securities, who happens to be the sponsor of our next panel. I'd like to welcome to the stage Maurizio Izureta, Head of Prime Financing Sales, Market Makers, and Broker Dealers. He is a Managing Director at Bank of America Securities. Please help me in welcoming Maurizio to the stage.
So live your life. You steady chasing that big car, just live your life. Ain't got no time for no hit.
Hi everyone, thank you for being here again and welcome. I have a very easy job today. I'm here to introduce our first panel, and all I have to do is introduce our moderator. As a moderator today, we have Stacey Gilbert, Chief Investment Officer at Glenmede Investment Management. I'm sorry. Thank you.
I can't stop this feeling. If it's even for a minute, I try to maintain. Please don't stop this feeling. If it's even for a minute, boy, it won't be the same. 'Cause you're everything. I can't stop this feeling. If it's even for a minute, I try to maintain.
Thank you. I'm just going to be a waitress here for a minute, so excuse me. There's nothing I find worse than being on stage and dying of thirst and then getting that annoying cough. So excuse me while I play hostess here for a minute. Hello, everybody. My name is Stacey Gilbert. I'm the Chief Investment Officer at Glenmede Investment Management. Just a quick background on me, and then I'll actually introduce the people that I know you're really here to listen to. I worked for Susquehanna International Group for 22 years. I did basically anything and everything that was related to listed options there, traded on the American Stock Exchange, ran the education department, ran the derivative strategy team, and 5 years ago was recruited over to be a portfolio manager of derivatives at Glenmede Investment Management, and then eventually took on more responsibility to become the CIO. Why, you might ask? Because I'm really good at being annoying to people and asking them why do they do the decisions that they do. So that's how I ended up in this role. But let me do a quick introduction here of our panelists here. And the one thing I would ask is if each of you can just wait till the end, because one of the most awkward things, at least for a moderator, is trying to figure out when the applause is done. And I really don't want to have that like ET neck of like, okay, wait, ready? Oh, nope, not yet, not yet, not yet. So let me just introduce my panelist up here today. First, Meaghan Dugan. Meaghan is head of options at the New York Stock Exchange. Prior to joining NYSE, Meaghan was head of products for U.S. electronic options and global future algorithms at B of A. And prior to that, she was a lead market maker in the automated market making business at Morgan Stanley. Meaghan is also an exchange director of the OCC's board of directors. Steve Sosnick is right next to Meaghan here. Steve is the chief strategist at Interactive Brokers. Steve also serves as head trader for the firm's trading division. He's a member of the firm's holding company. He's held numerous roles, starting when he joined Timber Hill in 1995 as an equity risk manager and an options market maker. Steve led the firm into Canada in 1998 and managed the Timber Hill Canada throughout its existence. One of the things I would just mention is that Steve has moved into a much more client-facing role with his original chief options strategist role, and as I just found out, his newly named role of chief strategist that he decided that that was the appropriate name for his role. Steve is also very much on the media scene and has been on several boards of both stock and options exchanges. Lastly, Patrick Zielinski. Patrick is CEO of Box Options Market. He's been with Box for over 20 years. He's held several key positions in business development and market operations and served as chief operating officer. Prior to joining Box, Patrick worked for RBS Citizens in the areas of audit and risk management. So now if you can say welcome to my panelists up here, please. Great, thank you. All right, so the name of this panel, Where We Are and What Is Next. So one of the first questions I want to start with is, if you can recall the start of 2023, what was kind of the investor consensus expectations at that point? We're definitely headed to a recession. The Fed was going to kill us. They were going to have to cut rates at the end of 2023. Everything was going to be very, very terrible for 2023. Obviously, it didn't turn out to be. Where were we coming into 2024? We've probably avoided a recession, or at least that's the investor expectations. Is it going to be a soft landing or no landing? What's happening here? Inflation is much stickier than we thought, yet consumers are spending a lot more. GDP probably has the same type of volatility that the meme stocks did in January of 2021, and I would be remiss if I didn't mention that the geopolitical situation has changed. So Steve, I want to start with you from the economic standpoint. Over the past year, what were some of the largest surprises from your perspective, and more importantly, what are you anticipating going forward?
Well, the surprise to me was sort of how everybody crowds to one side of the boat or the other. I guess I shouldn't be surprised by that, but there's a huge recency bias in terms of analyst expectations for the coming year when you get those price targets. So end of 2022, we were going to hell in a handbasket. Everybody was predicting a down market. We didn't get it. Coming into this year, we were on a big high. Everybody's predicting to the moon, and you already had people raising them as soon as they approached their price targets. When we came into the year, we were somehow expecting both a solid economic backdrop, call it a soft landing to better, and 6 or 7 interest rate cuts. That is a mutually exclusive combination. We knew we weren't. There was no way to get it both. Then we started to change, and as the rate cut expectations dissipated and interest rates rose, we're okay, because it rose because of economic activity rising. That's a good reason for interest rates to rise. You can get a rising stock market with higher interest rates if that's your circumstance. Now I'm starting to worry, and I'm going to even use the stagflation word here because, you could see the results today if you're paying, if you happen to see it. We're starting to get weaker economic prints at the same time inflation is not cooperating. And that, to me, is going to be a theme, I think, going forward that we're going to have to reckon with. One way or the other, we'll find out what the Fed thinks tomorrow afternoon. But this is where we are now, I think.
So stagflation is becoming the word of the year, or at least the concern of the year from your perspective.
I think so. It hasn't come out yet. But I do have to be concerned about that. Yes.
Patrick or Meaghan, any other thoughts of what's happened, like surprises to you over the past year? Whether it doesn't have to be U.S. economy specifically, but within your world, anything that surprised you or anything you're expecting?
Well, from the options market side, and Henry did a great job as always, kind of giving us an overview of kind of where our current industry is looking at. But we've seen our growth continue to evolve, and we've seen the technology side of things as well as the overall growth of the U.S. options market go in line with the strong equity markets, right? And that's also coming from the strong capital markets, right? That we've seen. It did slow for sure post-COVID. It's certainly picking back up again, and I know we'll talk about that. But I think it's surprising because we've seen the diversification of growth in the U.S. options market continue to be very, very strong.
Yeah, I would just add to that and echo Meaghan and Stephen that until kind of there's more certainty with the Fed and just corporate earnings and consumer spending, I think it's all kind of converging now, as Steve pointed out. So up until this point, it's been amazing how the market's been able to digest some of the there's really a lack of volatility in the market given the backdrop of all these macro things as well as the geopolitical situation. So could make for an interesting second half of the year for sure, to where the status quo could be changed, which obviously options are useful for managing that risk and sourcing liquidity in the time of need.
So you bring up the second half of the year. For those that don't know, I live in the great state, or also known as Pennsylvania, where you may or may not realize that it's one of those swing states. So while I was watching the disastrous performance of the Sixers thus far, every other commercial was related to this major event that we're going to see in the second half of the year. I often think of this as basically the 2020 presidential election hangover part 2, without the funny wolf pack here. So if we think about what's going to happen in the second half of this year with the election, without getting into politics specifically, because I know how well that'll go over, we can wait a couple hours so we have a couple drinks in us, and then we can argue, but in general, what is your expectation in terms of the impact to your businesses, the impact to the way that investors are positioning, and more importantly, the impact to their longer term objectives from your business perspective or an investment perspective as it relates to the presidential election?
So I'll jump in. We're sort of we know that the coming election is certainly a volatile time, and we've seen historically sort of the markets come back and grow post-elections, and we expect that most likely to continue and most likely have a very strong end of year in the equity markets. But from an exchange operating perspective, our main goal is to provide transparency and stability and resiliency in every market. So we really don't have a view on the overall market political landscape coming up. We just know we need to be there every single day like we are today, and we will continue to do so.
Yeah, sorry. I would add a similar tone to Meaghan from an exchange point of view. We're the operator. We're more in the infrastructure of the trading business, and so whether there's an event or not, we have to be prepared for it. And I think that comes with our forward-looking capacity and planning. In terms of just making sure we have scale in the system to digest these incoming messages and push risk in and out of the system. So from an operator point of view, it's just imperative that we, in the entire industry actually, from retail brokers to risk management clearing firms, in the entire ecosystem. And there's been examples in the past, especially the last big vol event, during COVID, we're able to push an enormous amount of risk in and out of the systems almost flawlessly, knock on wood. And that's how we approach it. So we're not looking at one event. It's just more forward planning, the next 12, 18, 24 months out, and we make deliberate changes in order to support the needs of the industry.
And thinking about it from my point of view, geopolitics is this weird background noise to some extent. I think, equity traders are really not particularly good at it because the equity investors as a whole and traders, as an adjunct, we're very good about figuring out what can impact, earnings, revenues, cash flows, et cetera. But then there's this whole, what happens in the outcome of politics, and that feeds into what Meaghan was saying and what Patrick was saying was, there's this nervousness that comes in beforehand and then sort of a sigh of relief, regardless of what the outcome is, because then at least you've removed this uncertainty. And so I do think that there's an environment, particularly as we get into the summer, if things remain as much of a toss-up as they are now, it would not surprise me to see volatility, particularly as you start to, and I think you'll see that expressed in longer-term bets. Probably, the VIX futures always already have a hump, in November of October of 2020, whatever an election year is, because remember they're looking 30 days out. So you already have that little hump. It wouldn't surprise me if you saw a little bit extra in there, but it also wouldn't surprise me if you started to see just general nervousness come in a little bit, because we have so many moving parts at once.
Yeah, the way we've always looked at it also is it's not just the presidential election. You have to figure out what happens in Congress as well, because as we know, a divided Congress tends to be better for markets versus one that's, from a political standpoint, all aligned and then different agendas can get through. So I would imagine that's some of that volatility as well if you're thinking about the various scenarios being priced in.
I did talk to a friend of mine who's a political consultant about this recently, and I'll keep his name off the record. But basically he's saying the presidential election's a toss-up, and if he had to bet now, both houses flip. So what do you do with that?
Right. I think probably, as Henry was alluding to, the zero DTEs, because will this be our first presidential election with zero DTEs that are trading? Yeah. So it'll kind of be interesting to see what the volume is that day relative to some of the other days. So from the options perspective, that could be just an interesting conversation. So kind of shifting gears here, if I think about words of 2023 that really just stuck out, There are really two that come to mind when I think about just in general what were some of the shifts within the market. And it's basically they're related to the same thing, concentration or Magnificent Seven. Right? This was something that wasn't really talked about very often prior and then became a major talking point pretty much through every financial media outlet that there is. So just some backstory here. If we think about the S&P 500, you've got the top 5 names being basically 25.2% of the index as of the end of the quarter. If you think about the Russell 1000 growth, those top 5 names are 42.1%. If we're thinking about how that's changed over time, that's basically double the exposure of the top 5 over the last decade for the S&P and triple for the Russell 1000 growth. So let's just think about sectors. So when I think of the S&P 500, I often think of it as being a diversified portfolio that is supposed to represent the US economy with various sectors. Currently, you have 42.5% represented by Tech Plus. So that's information technology as of 2018 plus Amazon. So by definition of diversification and fair full disclosure, I work for an active management firm, so I think of diversification a little bit differently than 42.5%. Let's couple this with a couple of other things so that we can bring in both the exchange perspective and the investment perspective. So Morningstar just published that passive now has more assets than active management. And in fact, last year, even as concentration was growing in a number of these indices, almost $200 billion went into passive and about $50 billion came out of active managed large cap blend strategies. From an options perspective, what would historically have been a diversified large cap portfolio that may have used an S&P 500 put as a hedge may not have that same correlation it once did when 5 names are a quarter of the diversified portfolio. So it's a lot. I'm gonna pull a Ted Lasso line here. It's a lot to unpack there. Give me your best shot of kind of what you think is most interesting, most concerning. Are you concerned from an exchange perspective? Is there anything you're worried about with this concentration, whether it continues or reverts?
You know, we've seen that concentration for sure, absolutely coming out of, again, 2022, going to 2023, when short-dated options became a much bigger part of the overall volumes. And that has even Henry's slides showed this, like increase the number of market maker to market maker transactions. Typically, back in the day, that would be extremely toxic and people would be running the other way. But that has not been the case because there still continues to be edge in each of those transactions for it to be continuously in a growth pattern. So, you know, the concentration is an interesting topic to see, and we are seeing that on a symbol level basis and on a market maker and a complexity of the actually order flow. The question, the question you had is, are we concerned about it? I don't see a level of concern from sort of my seat and my viewpoint. It does become interesting when you overlay that with other products like we will chat about around ETPs and other things, which also constitute some of this volume in these very highly correlated names. But no, not from an exchange perspective.
Okay. I would just tack on to that would be, although there's a concentration of names, there's different views of opinions of what happens in those names, which by itself could diversify out. You know, it's not necessarily one directional or the other. So I think there is. Yeah, it's concentrated from a volume and a messaging point of view, but ultimately it's a market, and there's just different expressions on overall direction and strategy.
You know, I think concentration is an issue no matter how you slice it. You know, there's still a relatively high concentration among people who are active liquidity providers, even as the places to provide said liquidity fragment and increase. You also, in terms of the products themselves, yeah, you're right. I don't think most people realize that if they're buying spiders, that they're essentially buying a quarter of their money is going into the Magnificent Seven. It's really very tight. I think also a lot of people don't appreciate, I think traders do, that essentially the NDX and SPX, they're, depending on when you're measuring it, call it 95, 97, 98% correlated, except that NDX is just the more volatile alternative. So I think all this, you know, if you're going to move from spiders to Qs or vice versa, you're not really changing your exposures much. And the other problem is, if everybody, think about it like a crowded theater now. If everybody's crowding into this AI-ish trade, you know, what happens if people want to exit it? That becomes a real concentration risk, because who's there to buy it if everybody's long? And I called the rally that we saw early in the year weaponized FOMO, just as everybody was like trying to make sure they were long the stocks, or you saw the incredibly flat skews in certain stocks because people they didn't want to necessarily pay $900 for Nvidia, but they'll buy the calls so they don't miss the move. And I think that kind of concentration can be problematic. And one of the things that worried me was Mark Zuckerberg's comment the other day when he said it's going to take years for our AI investments to pay off. Well, what are we doing then? You know, think about the internet era. Unfortunately, some of us on the stage remember this because we were trading then, but the internet was everything they said it was and then some. But didn't mean those were all great investments because it took a while for them to materialize. And by the way, neither Alphabet nor Meta existed. So we don't know the winner, you know, the ultimate AI winner could be some kid who's 15 years old in a garage right now. We don't know.
Yeah. So you bring up AI, and I think that's actually a great segue into the next question here. So NVIDIA, so it's gone from around $350 billion to now an over $2 trillion company in about 15 months because AI is going to save everything. And I think Henry had talked about this, the volatility smile of NVIDIA. It's one where upside almost has the same type of implied probability as the downside, right? The risk is also a crash up as much as a crash down in NVIDIA. But the reality is, if NVIDIA is really worth this because AI is going to change the world, and Steve, I'm with you, I traded pets.com, so I've got some biases as it relates to the .com era as well. But if we're thinking about AI as being as revolutionary as it is, where are the business impacts? Where are the other investment impacts? It cannot just be one company. There has to be productivity that is better across every industry, and I would think our industries as well. So I'd love to know how each of you is thinking about incorporating AI or just the risks to AI, or how do you incorporate AI into your businesses going forward?
Yeah, I think, so stepping away from the exchange side for a moment, you know, I think the use case of the choice that's out there to understand which tradable instrument or what kind of investment profile you want to get into will be driven more so with more AI-based decisions. From an investor standpoint, at least that's what I would imagine from my previous history. From an exchange perspective, we transact and we process billions of messages every single day. We have a strong surveillance team, as the other exchange partners do as well, to ensure that we're operating a very safe market. And we can't do that on a trade-by-trade basis, and we haven't been doing that on in a really, really long time. So we've been employing a lot of AI over time, using large language models to be able to understand sort of where we're looking to be able to get to understand potential bad actors, to understand patterns and practices that we should be able to adjust and really address to continue to provide a stable, resilient, transparent market so people are comfortable and confident trading on any of our exchanges. So there are definitely use cases that we'll continue to utilize AI on, but I think also from thinking about broadly about the market from an investor profile perspective, and they're looking at the U.S. options derivative space, I think the use case is going to be driven a lot with what kind of instruments can we utilize to be able to get into different profiles.
Yeah, I think just adding again to Meaghan is obviously AI is a very powerful set of technology, and it can be used to gain efficiencies and just do things at mass and scale when obviously computing. So when I look at the exchange business itself, it's like, you can come up with, and this is starting to happen in other markets and equities, is just making these advanced order types that collect these signals and become actionable within the trading house based upon the conditions that are happening within the market, and consuming that data and being able to manage an execution experience. That's one aspect of AI that's very interesting from an exchange point of view, or even just from a completely different spectrum would be how we. At the end of the day, we're a technology company, and we're building software and infrastructure. So what can we do with managing some of these like routine activities and have our resources deployed to more, interesting or not? Do you take some of the common code lines and you can have AI kind of, build that framework while your developer now is working on other solutions and designing process flow instead of doing routine commands in a code line or code base. So from an exchange point of view, AI is very interesting looking at it from different angles, whether it's from execution or just becoming more efficient with technology.
You know, I do think it's important because each of you raised very key points. Meaghan, you mentioned you've been using AI for some time. It's not new. Generative AI is new, but the concept of various concepts of artificial intelligence go back decades, neural networks, et cetera, et cetera. It's been getting better and better, but you know, it's how do we then utilize it? And Patrick, you mentioned the comment of like, can you use AI to do boxes of code? I mean, one of the first things I used to, when we'd get someone new on the desk, and we didn't do our own full programming, but we did a lot of smallish programming, and I would always tell these guys, plagiarize. If they're right out of college, you got to be plagiarizing because, you know, then it's plagiarizing, now it's work product, and just don't write the code over again. Well, if you could have AI do the basic stuff, well, then you can have our programmers do more interesting stuff. I have been part of some conversations, brainstorming conversations within our organization, and we consider ourselves a technology company too, and how we can apply it. And you know, we're actively thinking, I can't get into details, but we're actively thinking of how we can use AI to get more information in a coherent manner to our customers to help them make better trading and investment decisions or manage their risk better.
Yeah, we've thought about it a lot from even, well, I'll say the investment side of, there's nothing worse than reading a 10K, a 10Q, an earnings recap of some sort, but understanding the nuances to some of the language that's in there can be highly productive and just much, again, it's going to help with the costs of, do you need research analysts to do all of this, or can they be more focused on other things that have bigger impact to the actual environment?
Stacey, there's another area too, from the exchange standpoint, is definitely on the SEC side. So
I was
building out the
I wasn't sure if the SEC was in the crowd here, but I was going to throw it out there. The SEC side is yes. The SEC side is certain. This is why I'm very careful what I'm saying about AI, because the SEC side of things. So I think it's very fair. That is certainly. I think we'll have to think about that as we're talking about AI. So the one question that we were all in agreement here had a lot to do with the growth of mutual funds, and really more importantly, ETPs that incorporate derivatives. So I worked for Susquehanna for 22 years. I left 5 years ago to join a mutual fund company because I was a big believer that derivatives, particularly within a wrapper of some sort, had earned their way into the asset allocation conversation. I thought that they could actually, if you had a strategy that incorporated derivatives, if you think about derivatives as income or protection, if you incorporate them in a certain way, you can make an argument that it belongs in somebody's asset allocation. So if it's there, clearly I was not the only one who believed that. So we're about $100 billion later in terms of products that have just been launched and money that has flown into these strategies. And now I get the question quite often when I talk to clients of, has it gone too far? Can the options market absorb more? Is this suppressing volatility? What do you think of all of these strategies that are out there? So I have my opinions, but I certainly would much prefer to have all of you kind of answer what's your thoughts from either the exchange perspective or the investment perspective of how these strategies are being used.
I think it's a very exciting time. I think this area in the market right now really offers what we like to call sort of a democratization of access to structured products for retail investors or institutional investors. So these ETPs, largely within them ETFs, sort of have really grown what we've seen 3x in the last year. And as you mentioned, growing from $18 to $20 billion to now north of $100 billion, in AUM, which is an enormous amount of growth in a very short period of time. If you talk to the ETF issuers, I feel like their eyes are set on a very big growth curve coming up to the end of 2024 into 2025. So I think from the creation redemption side, from speaking to our ETF team and the ETF issuers at the NYSE at least, there's huge upside in this market, and I think the growth will continue to grow. But you bring up a really good question, like to what extent we've seen the flex volume growth in the overall market, which is a component from these ETPs with defined outcomes and embedded buffers within them. And so the market will continue to be able to grow with those. The concentration will probably continue to be concentrated, but I think the market space is really willing to be able to take in that growth and continue that trend. And we foresee that happening absolutely from both the creation redemption side into the ETF side into the actual market transaction side.
I want to take Henry's slide where he had basically 15 trillion of basically is what the notional value was of open interest. It's like, no, there's real liquidity in the option space. So I'm sorry, Patrick.
Yeah, I was just going to say, if we compare this environment to 6 years ago, right? I mean, rates were low, volatility was low, and there was just an enormous amount of people trying to search for yield, right? And I think they've learned from that experience, certainly coming and looking at what happened in the options market from 2021 coming out of the pandemic, whether it's memes. I feel like these institutions, endowments, pensions funds, et cetera, they got the new mandate to find a way to diversify their portfolios and use these option strategies to generate income. So I think it's quite interesting. I think this is something that the industry was waiting for a while, was to get some of this flow onto the screens there.
There are two things that kind of concern me about this, and I have no concerns overall, because I do think the industry is deep, the industry is liquid, but there's the other, and the other slide that Henry had up was how implied volatility tends to outpace realized volatility until it doesn't. And we haven't had one of those environments yet. We had those maybe when the industry was 10 or 15 billion. Now that it's call it 8 to 10 times bigger, we haven't had one of those. And whereas I'm confident that you know how to manage the volatility for your fund, because you wouldn't have lasted at Susquehanna for 20 plus years if you didn't, I'm not sure that all the others do. And so I think that every new financial innovation gets a real world test, a real world moment. We haven't had that test yet. I certainly hope we pass, but I think it will sort of separate the funds who do pass and who don't. I think we learned that, let's say, during the Volmageddon era, where we realized ETNs were not really the way to go. There's things that come up in all these. There's always something, but I do think it's also right now systemically put a bit of a lid on volatility, which is why historically you sort of had VIX in the high teens, and I think now you sort of see it in the low teens. And and the other question is, as Patrick mentioned, there's the idea of using volatility to get income. That makes a ton of sense when interest rates are very low. I can make 5% and just leave it in a decent bank right now. I can put it in a money market fund in my firm and just get 5%. So I see the logic in it, and I'm not bearish about it at all, but I do think that is out there, and I think that if and when, there will be another one of those times where the curves cross, or I guess like Ghostbusters, don't cross the streams. But that will be. I'm optimistic that the good funds will pass the test, and I just hope that the ones that aren't as well managed or well thought out don't create a problem.
That's fair. And we actually run a short vol strategy, so I'm very conscious. As I say, I manage risk for a living all the time. But you bring up the interest rates here, and I think this is. So if you thought the concentration kind of went off the rails a little bit, this is definitely, just kind of stick with me here as I get through the question. So our small cap analyst, Jordan Irving, actually has this thesis that I think is pretty interesting, that the cost of capital as we knew it, particularly for the last 15 years, was basically zero. It was free money, right? So what were some of the impacts we saw with free money? We brought up here that income, the need for income was certainly one of the areas that we'd seen. But we'll make an argument that private equity benefited tremendously from basically free money relative to the public markets. And so I'm going to put something in perspective here. Starting at 2000, kind of down to where we are, we have probably half as many listings on all of the exchanges as we did back in 2000. Whereas private assets, this is more than just private equity, has basically increased 12-fold. It's about $12 trillion now. This is a significant increase in private assets. What's really interesting about private equity is if you look at it around the financial crisis as rates go to zero, you can see this tremendous growth. And then where you see a parabolic growth happen is really around COVID, where not only did interest rates go to zero, but substantial liquidity was pushed into the system. So now stick with me here on the public side. Russell 2000 index. Financial crisis and prior, about 22% on average of the constituents were what we would call negative earners, meaning they didn't make money over a 12-month period. From the financial crisis to where we are now, that average has been 33%. So basically a third of the Russell 2000 index doesn't make any money. And it peaked in January of 2021 with about 45%. So 45% of a 2000 index didn't make any money at all. Okay, maybe that's really not that big of a deal. Maybe this is kind of what we would expect to be standard. But if you actually look at the constituents that went into the Russell, 2 times as many of these new entrants, meaning they were IPOs or spinoffs, didn't make any money relative to those that had been added that had been around for a little while. This was well off longer term averages. So basically what we'd seen since money became free is what got brought to the public market didn't make any money. And that got put into some of these indices. So the positive that we think from this is as the cost of capital has changed, private equity may now have to IPO again. If this is their exit plan, they can't just sort of kind of pass things around as cost of capital is zero, and you actually have quality assets potentially coming to the IPO market. So now I'm really putting myself at risk here by saying this on stage and then turning and asking the exchanges, hi, by the way, is this a good thesis or not? But I kind of mentioned the thesis here. Does it seem consistent with some of what you're seeing or conversations you're having around IPOs now?
Yes, absolutely. So
Thank goodness.
it is an interesting time for sure. To your point, if we go back a handful of years in 2020, 2021, when the rates were very low and there was a big shift of capital into the markets, it was a very strong capital market regime at that point in time. We had 1,200 new underlyings that came to market that yielded 500,000 individual tradable instrument series for the general options market to be able to trade. So we went from something like 700,000 series to trade in end of 2019, early 2020 to now 1.2, right? 1.2 million series to trade, over 4,000, under 4,000 plus underlyings. So what does that mean now? From the listing for the IPO market is that it is expensive. The private equity market needs to be able to put more money into the market, and it's expensive for them to continue to do that at 5+%. So, and the companies themselves are becoming much more strong. So we've actually seen, at least on the year-to-date proceeds side, from the IPO side, a 3.5x growth year over year in overall IPO proceeds. And we're happy that 7 of the 10 largest IPOs that have come to market this year have been at the NYSE, but we continue to see that growth in 2024 and even accelerate into 2025 even more so. One great thing that we all worked together on from an industry standpoint was last year we were able to get SEC approval on fast-tracking listing options within 3 days' time instead of 5 days' time once an IPO met a certain level of criteria set. So we've actually seen that happen and benefit the overall options market because we can bring more trading instruments to this community for them to provide bids and asks to and retail and investor institutional order flow to go to. So we're continuing to see that happening. We have a large IPO tomorrow. Viking is coming to market, and we expect that to also hit that threshold once our reg team goes through the criteria set. But from an IPO standpoint, the proceeds alone have increased substantially, and we feel like there's a very, very strong pipeline coming in based on the fact that the stickiness of rates remains to be quite high, and the private equity market wants to be able to it's too costly for them to continue to manage that.
That's good. So that's actually, I think, a positive we can talk about all of the impacts of higher rates, but this could actually be a positive for the ability of public markets to have, we'll say, potential companies that actually are generating profits.
Yes.
So we're coming into our 5-minute mark here. I will say if anybody has questions, by all means, raise your hand. We're not afraid to answer questions up here. But I do want to sort of take a shift. As a moderator, I probably talk way too much. I warned them as we came in that I will probably talk way too much. So I want to recognize that there are probably many topics I didn't get to. So Patrick, we're going to start with you. Is there anything that you want the audience to know that I didn't ask, or even just reiterating something maybe I did ask?
I mean, I think we covered most of it. I don't have anything specific that to box, but just overall, just good to be at the conference here and celebrate the industry and look forward to a successful remaining of 2024.
I guess from my point of view, the continued compression of the expiration cycle, as I prefer to call it rather than DTE, zero DTE. But I think that raises the question as an industry we're going to have to wrestle with, the inevitable of when do we get some single stocks in there and how do we handle them? And my view is we're going to have to adjust the way we do things because you have an hour and a half of which to exercise an option as opposed to 6.5 hours to trade it during the trading day. And a lot of individual customers don't realize it. And there's a lot of stuff that happens, that occurs on a Friday. It's the same ratio, but individual stocks don't tend to have those gaps on Friday. And I think that's something we have to really think about as an industry of how do we address that? Because we all get paid on volume. Everybody in this room gets paid in some way, shape, or form by volume, and it's the obvious place to go look for the next volume.
Yeah, I will say to the zero DTE, we didn't bring it up. I know there will probably be a number of conversations around it, but I always find it really interesting the way that all of the articles are written about the zero DTEs. I just want to be like, you never traded options if you really think people are sitting there naked short the whole time. And Mandy Zhu from the SIBO has done a number of different presentations on this and a lot of work behind this. I think it's interesting, this thought that you sold it at a quarter and you let it go. I mean, I would have been fired on day one if I didn't understand how to hedge that risk. Sorry, Meaghan, so anything?
So I feel like we sit in a very strong position in the overall U.S. options market. We're sitting very closely off of the derivative market of the U.S. equity market, which continues to be a very strong space to be in. We continue to grow our transparency over the markets from our growth. We talked about, additional ETPs coming to market coming this year. So a couple trends that we definitely will see continue to help drive, I think will continue to help drive volumes to our markets. Lots of overseas, LATAM, Asia interest of our growth that we're seeing here, which is great to see and great for a lot of folks in this room. So I think that there's a lot of interest, across the globe on our markets. We definitely think that the ETP growth will continue and flex volume will continue and possibly single list zero TD. So I think there's a lot to be interested about coming into the end of this year and into 2025. It'll be interesting to see where we are next year when we get to OIC next year, wherever that's going to be.
Yeah.
Does anybody know?
Do we know yet? Do we know where it is next year? Not announced yet. We have to wait till the end of the conference. So I'll do one last scan if there are any questions out there. Obviously, we are headed to a cocktail hour shortly, which questions get much more entertaining, so feel free to obviously follow up with any of us at that point. But otherwise, I want to say thank you to the OIC and Tricia Pearl for the invitation to be here, and thank you to Bank of America Securities for sponsoring the panel, and thank you to my panelists for a wonderful conversation. But thank you, everybody.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.